start this class. In this class, we're going to look at market structures, and under that, we're going to look at types of market structures, how to trade market structures. We're going to look at something called the Wyckoff strategy. Then we are going to end this class with something we call break of structure, market structure shift, and lastly, we're going to look at change of character. So just to jump straight into that, let's define what market structure is. So market structure in trading basically refers to the organization and characteristics of financial markets where assets such as cryptocurrencies, stocks, bonds, commodities, or currencies are bought and sold. So market structure is organization and characteristics of the financial markets. As we proceed, you'll be able to understand in depth what market structure is. So we have three main types of market structure. We have what we call the uptrend, rather the bullish. Then we have the downtrend or the bearish. Then we have what we call the accumulation, and it has many other names. Some people call them the ranging markets, consolidation, sideways, or even the choppy market. So let's look at each type individually. So the first type of market structure is what we call a bullish trend or an uptrend. And we are being told right here that this happens when the market is making a series of higher highs and what? And higher lows. So let's demonstrate that. A series of higher highs and higher lows. So basically, we've said an uptrend. We all know what an uptrend looks like. It's a bullish trend. That's an uptrend. Like that. Let me just draw better. So an uptrend, we'll have an uptrend like this. Something like that. Yes, something like that. So we are being told, and this, let's remember, it's what? An uptrend. We are being told that an uptrend is made up of a series of higher highs and higher lows. So let's name these parts. So here we are having a high. Right here we are having a high. Then right here at the bottom, we are having a low there. So how do we come up about with series of higher highs and higher lows? So this part right here is a high. It is a high, but it is definitely higher than this previous high right here. This is a high, but higher than this previous high right here. So it qualifies being called a higher high. A higher high. Then we are having a low right here, but it is a low, yes, but it is a low that is higher than this previous low. So it qualifies being called a higher low. A higher low. Like that. This is the same. It is a high, yes, but it is higher than this previous high. So it qualifies being called a higher high. Let me see if we can just copy this. Copy and paste. So it is a higher high. Also the same thing, this is a high, but higher than this previous high. So it qualifies being called what? A higher high, like that. Then this is a low. This is a low right here, but it is higher than this previous low. So it qualifies being called what? A higher low. A higher low, like that. And that's why we are saying that an uptrend, we can define an uptrend other than saying that is a scenario where buyers are pushing the price higher. In more technical terms, we can say that an uptrend is a series of higher highs and higher lows. So basically, that's how we define an uptrend, a series of higher highs and higher lows. So let's see if we can spot some higher highs and higher lows on the chart. We are on the 1000 sats, the one that we were using yesterday on the 1 hour time frame. So if you look at this part right here, of what is a good example of an uptrend. And you have defined, like we have said right here, that an uptrend is a series of what? Higher highs and higher lows. So let's see if we can spot our higher highs and higher lows. So from this part right here, you can see we are having a low, we are having a high. Then we are having a low, but it is higher than this, so it's a higher low. Then we are having a high, higher than this, a higher high. we're having a low, lower than this, so it's a higher than this. It's a low, yes, but higher than this, so it qualifies being a higher low. If you go like this, it's a high, higher than this, higher high. The same thing, a higher, a low, but low, higher than this, so it becomes a higher low, and so on and so forth. So this basically, it's a depiction of how an uptrend looks like. So let's look at a downtrend. A downtrend will be just the reverse of this. So let's look at a downtrend. So you're having a series like this. A series will be the inverse of this. So it's a series of lower highs and lower lows. Lower highs and lower lows. So basically something like that. So let's look at the parts for this. Let's have that in red to have a difference. Then you can have this is a downtrend. A downtrend. Like that. So we are having this is a low right here. And this right here is a high. A high. Like that. So let's look at these parts. So we are having, let's start with the low part. We are having a low right here. It is definitely a low, but it is lower than this previous low. So what does it become? A lower low. A lower low, like that. This other low is also a low, but it is lower than this previous low. So it becomes what? A lower low. A lower low. A lower low, like that. No. A lower low. So this part also becomes a lower low. This low also is a low, but it is definitely lower than this previous low, So it becomes a lower low. The same. A lower low, like that. Then we are having the high right here. This is a high. But we are having a high. This is a high, but it is definitely lower than this previous high right here. This previous high right here. So it qualifies being a lower. It's a high, but it is lower, so it is a lower high. The same thing for this. It's a low. It's a high, definitely a high, but lower than this this one right here. So it becomes what? Also, it becomes a lower high. And no wonder we are saying that a downtrend, apart from us defining it as a series, as a scenario where sellers are more than buyers, or rather where sellers are pushing the price lower, in more technical terms, we can define a downtrend as a series of lower highs and lower lows. And that's what basically has been explained here. It happens when the market is making a series of higher highs and higher lows. I think I should have shown an example of higher highs and higher lows here, right here. If we zoom out to these, you can come and say this part right here is a series of higher highs. The series of, we're having a downtrend right here. Or even here. Also, this one is also like a downtrend right here. So we are having a series of what? A series of lower highs and lower lows. Lower highs and lower lows. And you can see that clearly from this part right here. Like that, up to that point. Lower highs and lower lows. The same thing right here. You can see that being shown like that, like that, like that. A series of lower highs and lower lows. Coming back to my slides, this is basically what was being explained right here. And for a downtrend, this is basically, it happens when the market is making a series of lower highs and lower lows. So let's look at, we've looked at an uptrend, we've looked at a downtrend, but I want us to individually define how we trade what? How do we trade an uptrend? So we have 3 ways of trading an uptrend, but the last one is the most efficient. So let's start with the first scenario. Breakout traders will tend to buy, but will get stopped out when the market is coming down. I repeat again, breakout traders will tend to buy, but they'll get stopped out when the market is coming down to form a higher low. I want us to remember something. Let's go to our higher highs. Where is it? Yes, let's go to our uptrend. Remember, our uptrend is made up of a series of higher highs and higher lows. But you have been told breakout traders will be stopped out when the market is coming down to form what? A higher low. Let's look at that scenario. First of all, let's define what breakout traders are. So breakout traders are the type of traders that we like to call the FOMO traders. For example, we have seen today, just coming to this part right here, we've seen the market has done a really nice recovery today. So someone will come, see that the markets are green, and they want to ride that wave. And that's basically what we defined as FOMO traders. FOMO traders, fear of missing out. They're fearing to miss out on the gains, so they want to FOMO in. Someone to tell us when the market is green, when's the best time to buy tokens? The best time to buy tokens or assets or crypto assets? What's the best time to buy crypto assets? The best time to buy crypto assets? Someone? Let's have someone else apart from Joseph. Sly?
It's when the cryptos are red. Like
Why?
Because the prices are subsidized then.
Yes, let's appreciate Sly. The prices are subsidized, or rather, the prices at a discount. When we were starting this class, I think in March, if I'm not wrong, the price of Bitcoin at that time was around, I think 77, if I can remember, 77 or 75, around there. Today, Bitcoin is at 101,000. So if you bought at that time, then you're up. But what I want to say is, the market is still at a very good discount. Honestly, I just feel we're just at a discount. Okay, you might have missed the Bitcoin wave because it's already up right now. But looking at every other asset, even though we have pumped, yes, it's not that far. A coin like AVAX is still at a discount of $21. Where is AVAX? You can see it. But it's still at 21. Many coins are still at a discount. Jasmine is still at a discount. Many altcoins are still at a discount. But maybe the Bitcoin, you might have missed the Bitcoin wave, but can still invest in very good projects, altcoins. They are very good tokens. Even Dogecoin is still at a discount. Dogecoin is still at a discount. AVAX is still at a discount. Like LTC, very many coins are still at a discount. So you're not late. But just to come back to the FOMO traders, as we're discussing, we have said that the FOMO traders are the kind of traders that you want to call the breakout traders. So when you see a breakout trader, these traders are the ones that we like to call the FOMO traders. So they'll see a situation like this in the market and they want to FOMO in. Remember, there are people who bought when the market are red. So definitely, some people are collecting profits, and when people are collecting profit, we call that act as sell. You're selling to collect your profit, so you'll expect some retracement. The market will never go like this in a straight line. No, we'll always have retracement. Let me just delete that. We'll always have retracements like this. It will go up, down kidogo because people are collecting their profits. Then as it goes down, there are some people who have seen now the prices at a discount. They buy up again, the market goes up, they collect profits, the market sells. Some people see the prices at a discount, buy at that point, and so on and so forth. But when it comes to the breakout traders, what do? They FOMO into a trade. So they'll come, see the market is making a series of higher highs and higher lows, and they basically want to buy in. Let me change this to green. They want to buy in at this point. So what did they do? Remember, they are FOMOing in. They are just entering to ride the wave. So they'll enter from that point, for example, from that point like that. So what will happen? They'll have their long position tools at that juncture like that. Then they're expecting the market, remember they're riding the wave, they're expecting the market will continue like that to their take profit. But you have said that there are some people who bought when the market was here. So definitely when the market has pumped, they are collecting some profit. So as the market is coming, as they are selling, that action of them collecting profit is going to send the market down kidogo. It's what we call mitigation. So as the market is mitigating, or rather in more technical terms for the purpose of this class, as the market is coming down to form a higher low, remember an uptrend is made up of higher highs and higher lows. So as the market is coming down to form a higher low, it will stop them out before continuing with a series of higher high, higher low like that. So no wonder you're saying being a formal trader is not the best way because you'll be stopped out at this juncture. So that's the first way. The second way, we're having the SNR traders. So SNR traders, first of all, just to test our knowledge. If I enter the market, the price is here. Let me do this. The current market price is right here at this first juncture. Current market price is right here. I want to enter my trade at this point right here. Let me call it part X. Which type of market order type will I set? The current market price is here. My entry is down here. So just to give you leakage, and market order type that allows you to buy an asset at a price lower than the current market price. What is it called? Let's have Sly again. Today you're very active.
Yeah, so it's limit order.
A limit order. Which type of limit order?
It should be a buy.
Yes. Let's appreciate Sly. Guys, yeah, perfect. So it's a buy limit order. So that is just basically to test you. Let's go to the second type of traders. The second type of traders is what you call the SNR traders, or the support and resistance traders. So traders will have their sell limits targeting the market to sell, but will end up being stopped out. So what are, first of all, let's define, let me delete this. Let's define SNR traders. So for an SNR trader, they are the support and resistance traders. So let me just show you how they do it. So for support and resistance traders, as the market is here, they always believe that this is the support level. No, actually, the resistance level, and this is the support level right here, the support level. So what do they believe? They believe that once price reaches the support level, the resistance level, let me just name this because I'm also confusing myself. Resistance, and this is the support. We'll look at that tomorrow. We'll define that in there. But for the purpose of this class, I want to understand, you guys to understand, there's a support and resistance traders. They believe that this zone right here is their support level, is their resistance level, and this part right here is their support level. So what do they believe? They believe that the market cannot break through the support level, and they also believe the market will bounce off from the resistance level. So they expect the market to come to the resistance level, bounce off to the support level, and so on and so forth until it breaks through. But rather, what do they do now? Seeing that, because they believe the market will bounce off from the resistance level, they'll come have their short position tools. They want to short the market because they believe once it hits here, it will bounce off to the support level. So they'll have that, their stop price at that point and their take profit at maybe that point. So what will happen? Remember, you said that the uptrend is made up of a series of higher highs and higher lows. So as the market is coming up to form a high that is definitely higher than this previous high, a higher high, it will stop them out before coming down again, lying to them that is going to come down and continue with the series of higher highs and higher lows. So they'll basically be stopped out of that trade. So what's the best way now to trade an uptrend? The best way to trade an uptrend is to wait for the market to pull back and form a higher low, then look for a good POI or point of interest and have a buy limit set. So let's look at that. Let me delete this. We use the same one to illustrate. Like that. So what you'll do, we know that an uptrend is made up of a series of higher highs and higher lows. So we know the market's going to come up to form a higher high, come down to form a higher low, and so on and so forth. So what do we do? The best way to trade this is to wait for the market as it's coming down to form a higher low, look for POI, then buy from that juncture. Let me just return this to this point so that I can explain vizuri. Let me delete this. I can do that again. So the market has formed a higher high right here. So what's the best way to trade? Wait as the market is coming down to form a higher low. Remember this series of higher highs and higher lows. So as the market is coming down to form a higher low, look for a POI. POI is a point of interest, maybe fair value gaps. So look at that, do not worry. Fair value gaps or anything on this leg, then buy from that zone. So have your entry at that zone right there, like that, and you take profit. So as the market, remember, we are setting a buy limit. Why? Because you are buying at a price lower than the current market price. So as the market is coming down to form a higher low, a low that is definitely higher than this, then you'll be triggered in and the market will continue to form a higher low and all the way to your take profit. So no wonder we are saying the best way to trade an uptrend is to wait for the market to pull back and form a higher low, then look for a good POI and have a buy limit set. A buy limit because we are buying at a price lower than the current market price. Before I even take any questions, Sly, you have a question? You can see your hand is up.
I just wanted to ask how which is a good POI.
Yes, we look at that. Not I don't want to mention for the purpose of this class. I just want you to understand this concept as it is right now. The way vague I need to understand. But with time, as we continue to identify more POIs, for example, like tomorrow we're gonna look at order blocks and breaker blocks. Then we're able to combine all these skills that you've learned and form a very good confluence. So just understand the way we are doing right now, just like that. Is that okay?
Yes, thank you.
Yes, it's a concept that you are building slowly or gradually. So let's go to a downtrend. Let me move to this side of the screen. You've already defined how a downtrend is, series of lower highs and lower lows. Let's look at how to trade a downtrend. Basically the opposite of how to trade an uptrend, or not even the opposite, the same of an uptrend. So number one, we have the first scenario, breakout traders. What have we said breakout traders are called? In other words, breakout traders. The simplest terms to remember what breakout traders are. Someone? Levi. Let's go.
Formal traders.
Yes, the formal traders. Formal traders. They've come to the market like this. They've come to the market like that. They've noticed the market is selling. They don't want to miss out on this sell. So what they do, let me change that to red. They want to just FOMO in and sell at that juncture. The formal traders, the breakout traders. So what they'll do, because they just want to jump into this trade, we'll have a scenario like that. So they'll have their short position tool. Remember, they want to short the market. They want to ride that short wave, or rather that downtrend. So they'll have their short position tool like that, and they'll expect the market to come to this point. Someone to tell us which type of not order block, which type of market order type they will set. An order type that allows you to sell an asset at a price higher than the current market price. Remember, this is the CMP. The current market price is right here. But they want to set an entry at this zone, but X, let's call this X. So their entry is higher than the current market price, and they want to sell. A market order type that allows you to sell an asset at a price higher than the current market price. Someone? Okari?
Sell limit order.
Yes, a sell limit order type. Let's appreciate Okari. So yes, it's a sell limit order type. So what they'll do, they'll have their sell limit order type. Instead of calling that LX, we can call a sell limit order type. Let's call that a sell limit order type at that juncture. So what will happen? Remember I said that a downtrend is made up of a series of lower highs and lower lows. So we expect the market to come up to form a high, but is lower than this, a lower high at this juncture. So as the market is coming to form a high that is lower than this one, a lower high, it will stop them out before continuing with that trend like that. So the former traders will be stopped out of the market at that juncture. And I want to say that's not the best way to trade an uptrend, a downtrend rather, a downtrend. So let's look at this next scenario. The next scenario is what we call the support and resistance traders. So the support and resistance traders, remember what we said about them? They believe they'll believe that this is the support, not support, rather resistance. They believe that's the resistance. Let me reduce this for demonstration. And they believe that this is their support. Where is that line? So they believe that this is also their support at that zone. So let me name this. This is the support and this is the resistance. So what do they believe? They believe that the market cannot break from this zone and neither can it break from this zone. So what do they do? Let me delete that. They want to buy this asset because they believe as the market comes to this zone, it will bounce off from the support zone and go all the way to the resistance zone. So they'll have their long position tools at this zone and their take profit may be like that, So which type of market order type will they have? An asset that allows you to sell an asset at a price lower than the current market price. This is where we're having our CMP. CMP is right here, but our entry is at this zone, X. Entry is at this zone. Not sell, buy, because they are buying. Which type of market order type allows you to buy an asset at a price lower than the current market price? Lower than the current market price. We've mentioned that just right now. A market order type that allows you to buy an asset at a price lower than the current market price. Someone? Joseph?
Limited.
A limit order. Which type of limit order in this case?
Buy.
Yes, a buy limit order type. So they'll have their buy limit order right here. Buy limit order type. At that juncture right there. So what will happen? Let me just move this to the left. Like that. So what will happen? Because they believe it will bounce off from this point and buy, but what will end up happening is that this market will come. Remember, it's a series of lower lows and lower highs. So as the market is coming down to form a low that is definitely lower than this price, it will come, stop them out before continuing with the trend. So they'll be stopped out of that trade. So what is the best way to trade a downtrend? The best way to trade a downtrend is to wait for the market to pull back and form a lower high, then look for a good POI or point of interest and have a sell limit order set. So let's do that. So we are saying that the best way to trade a downtrend is, remember, it's series of what am I doing? Remember, it's a series of lower lows and lower highs. So as the market, for us is to time, as the market is coming back to form a high, let me just use this to form, as the market is coming back to form a high that is definitely lower than this, then we can time that market at this point and sell from that zone. So essentially what you're supposed to have is from this zone, from this leg right here, look for good POIs, good order blocks, fair value gaps, QMLs, all those. We look at that later in the course of this week or next week. but this leg right here, identify a good POI, then have your entry at that juncture, your sell limit order set at that point. So what will happen is, as the market is coming to form that lower high, a high that is lower than this will be triggered into that trade, and as it continues to form its series of lower highs and lower lows, will be in profits. So that's the best way to trade an uptrend and the best way to trade a downtrend. So we have looked at uptrend, we have looked at an uptrend, we have looked at a downtrend, we've looked at ways, the best way to trade an uptrend and the best way to trade a downtrend. But remember, we said there are 3 types of market structures. So let's go to the third type of a market structure. That type of a market structure is what we call the ranging, the accumulation, the consolidation. Other people call it the sideways or the choppy markets. So this happens when the market is making a series of equal highs and equal lows. So equal highs and equal lows. Let's do that right here. Let me look for another space. Yeah, can do this on here. So remember, we've mentioned, let me have that in red so that it can be visible. Like that. Then we have another ray. Let me have two rays like that. Remember, we called this the resistance. And the easiest way to remember the resistance is just, we can use a little example like the room that you're in right now. We have the ceiling and we have the floor. So if you bounce a ball and it touches the floor, you don't expect it to go through this floor, but you expect it to bounce like that and go to the ceiling. And also when it hits the ceiling, you don't expect it to go through the ceiling. You expect it to do something like that on the floor, like that. So this is basically a choppy market. So just to name this, our ceiling in this case, our ceiling is what? Our ceiling is what we call the resistance. The resistance. And our floor right here, our floor is what we call the support. Like that. So our ceiling is the resistance, our floor is what we call the support. So the support and the resistance zones are a zone. They are not a line. They are basically a zone. So you don't expect to be perfect like this, but just understand that a choppy market or a ranging market is when the market is making a series of equal highs and equal lows. This can be illustrated by drawing support and resistance level, like we have done. So don't expect in the market to look like this exactly, that you're having a series of equal highs and equal lows, but rather expect something like this. Something like this, or rather what I've drawn right here. Instead of expecting the market to do equal, approximately, or rather very accurate equal highs and equal lows, like that, what you expect from the market is something like this. Like this. As long as it is a zone, as long as the market is playing within a zone of the support and resistance, it then qualifies being called a choppy market. Something like this, a choppy market. You're having the market playing within this zone like this. And if you come to this part, just to show you a live example that I identified before you even started this class, is this zone right here. Remember the 1,000 sats USDT pair. This zone right here is a perfect example of an accumulation. If you can see that thumbs up, you can see it's not perfectly equal highs and equal lows, but it is playing within a zone of the support, the support down here and the resistance up here. So as long as it's a zone, then it qualifies being an accumulation or a choppy. Depends on what you will decide to name it. So in this class, we can go with an accumulation market. So how do we then trade a sideways market or an accumulation or a choppy or a ranging, all those terms? In this type type of market structure, you usually have a lot of manipulation. And this is because we have a lot of indecisiveness and the pressure in the market, so you cannot know which direction the market will break through. What do we mean by indecisiveness? Remember, it's a series of equal highs and equal lows. Where is that? Right here. It's a series of equal highs and equal lows. So technically speaking, there is pressure between the buyers and the sellers. Remember, this zone, they almost have equal strength. So there's indecisiveness of whether the market or of whether the sellers will overcome the buyers and the market will break towards the downtrend like this, or the other way around, where the buyers will overcome the sellers and the market will break through the resistance level and go up like that. So it's a fight. It's a fight between the buyers and the sellers. And one we are saying there's a lot of indecisiveness in the market, and hence there's a lot of manipulation that will occur in this type of market structure. So when the market breaks in either side, like we've seen, in either side, either the side of the resistance or the side of the support, then what happens? It is oftenly. And when I say often or often, when you say often, we mean mostly, not all the times, but mostly. So when the market breaks on either side, that oftenly is a wrong move. Mostly, I'll replace that with mostly. When the market breaks either side, that is mostly a wrong move or a manipulation. So this is done to induce retailers are me and you, to follow that false move. So that false move in most cases is what is called a Judas swing or a betrayal move. So the actual trade will oftenly be the opposite of the manipulation, and that actual trade is what we call the distribution. So let's have an example right here. We have an accumulating market. Let's describe that, an accumulating. And you are being told that mostly or oftenly, if it breaks on either side, you should consider that move as what? A Judas swing or a betrayal move or a manipulation. Actually, you can call that a manipulation move. So it will lie to you or to the retailers that the buyers have overcome the sellers and they've pushed the price like that. But in real sense, the actual trade is a downtrend. So what do we call this? Accumulation, manipulation. Then this is what? Distribution. I'll repeat again. We are having accumulation, the choppy market. The Judas swing is what you call the manipulation, and the actual trade is what you call the distribution. AMD, the classic AMD, accumulation, manipulation, and distribution. So the actual trade will be the opposite of the manipulation, which is called the distribution. So what is the best way to then trade a sideways market? The Wyckoff strategy, or rather what you call the classic AMD. And I've basically explained that: accumulation, manipulation, then distribution. So the Wyckoff strategy, or rather what you call the classic AMD, is now the best way to trade a downtrend. Not a downtrend, a choppy market. So this means that once you spot an accumulation market, always wait for the manipulation move to happen and end. The safest way, always wait for the manipulation to happen and end, then trade the distribution by looking for a good point of interest. Distribution means now the actual trend that the market takes after the Judas swing, the real direction that the market will take after that Judas swing, or what you're calling manipulation. So wait for the manipulation to end, trade the actual trend. In this case, it was a downtrend. Another example right here, we are having a choppy market right here, accumulation. The fake move happens on this point, accumulation, manipulation. The actual trade is a downtrend, distribution. Let's look at this example that I highlighted before. So if I zoom out like this, you'll see that is what happened here. We had an accumulating market. Then we had our fake move, manipulation. I think I should have named this, but anyway, manipulation. Then the distribution is actually an uptrend. So what do? Come look for a good POI for the manipulation move. After the wait for the manipulation move to end or the Judas swing, then trade the uptrend. As simple as that. So the best way to trade a sideways market is to do the above. Wait for the market. Where is that? Wait for the manipulation move or Judas swing to end. Then trade the distribution. Sly, you have a question?
Yes. So that long week is now the Judas swing.
This one right here.
Yeah, the red one.
This one.
Yeah.
Yes, it's a Judas swing. But you also notice, no wonder I said it's good for us to know all the POIs for us to understand. But for the purpose of this class, I just need you to understand. In this class, we can only call this a manipulation. So if you combine more confluences, you'll notice as much as this is a manipulation, we can actually know where that manipulation will end from. If you see this part, if you can see this part, thumbs up and what I've written it as. Evans, I can see your hand is up. What's the value here?
50%.
Yes, 50% weak on the 4-hour time frame. Let me just change the color so that I'll increase the size and change the color. It's just because I never spendangi like my chart with a lot of words, so I'll sometimes fade them. So 50% on the 4-hour time frame. So a week is also a very good POI. It talks, or rather, it shows a lot of liquidity. So if I come on the 4-hour, but I don't want to bulk you with this, we'll progressively do that. So if I come to the 4-hour time frame, you see there's like a week here that was not mitigated. If you can see this week right here, thumbs up.
How did you come up with 50 week 4 hours? How did you come to that against that?
Yes, I'll show you just right now. But I don't want you to bulk up with this. But anyway, I'll just mention it. So remember we said you can use a gun. Okay, a week is also a good POI because there's a lot of liquidities in a week. And I'll explain later on why a week has a lot of liquidity that needs to be mitigated. So for me, I'll trade, number one, the first level a week is mitigated is at the base of the week. The base of the week. And if you look at this part right here, you'll notice that the base was already mitigated by this week right here. Can you see that slide?
Yes.
It was mitigated at that point. So the next part of that week that will be mitigated is actually what? Is actually 50% of it. And if I use a measuring note, a gun box, where is my gun box? A gun box is the one. Remember over on Tuesday when you're talking about trading view? Was it Tuesday or yesterday? Actually, yesterday when you're talking about trading view, here it is. So you can come use this tool to measure 50% of that. And if you see, it's 50% of that week, that line, where that line I've drawn is 50%. So that's the second part. And no wonder I targeted that part right there. So if you're good at doing this analysis, you'll notice which our time frame will be on. You'll notice that you can actually identify where the manipulation will end at. So if you come to the 1 hour time frame, you'll notice that now the market actually, the manipulation move was a fake move and more confluences to it. It was coming down to mitigate that week on the 4 hour time frame. So it touched that. Let me just make this white again. I want to make this line white and maybe increase its thickness so that you can all see. So if you look at that, you can see now that the week actually at that sharp week came to mitigate that 4 hour time frame week before now having our distribution. So remember, accumulation, manipulation, then distribution. And if you look at this part, you can also see that. Now I'm saying weeks are very powerful. They leave a lot of liquidities. You can see that this week actually came to mitigate this other week. You can see that.
Yes.
Yes. So that essentially is what. But you can ignore all that we have said. But for the purpose of this class, I just want you to understand that the best way to trade an accumulating market is what? Wait for the market to break through to either side. Wait for that Judas swing to end. Then you can trade the distribution. Any other question before we go to the last part of this class? Any other question? If everything is clear to that point, thumbs up. Perfect. So let's look at the last two things that I want us to cover in this class. I want us to cover what you call a BOS, a break of structure, and a market structure shift, or what is called a change of character or a trend change. But disclaimer, whatever I'll define here as a break of structure, someone else might call it a market structure shift. Another video might tell you change of character or whatever. It doesn't matter. It doesn't matter how, whatever you call it or whatever other people call it, as long as once you see them on the charts, you can identify them, then it's okay. But for the purposes of this class, we are going to define a break of structure and a market structure shift. So what's a break of structure? Is when a trend continues and breaks the previous high in an uptrend. Let me have something like this so that you can define as we draw. Let me have a part like that. Perfect. So we are saying that a break of structure is when a trend continues and breaks the previous high in an uptrend. So let's do an uptrend. Remember an uptrend? Series of higher highs like that. Like that. A series of higher highs and higher lows. What are we being told? That is when a trend continues and breaks the previous high. So his was our high. So that level, remember this is our high, the level at which the market continues and breaks. You can see it was broken. This high was broken at this level right here. So that level, that place where the market breaks the previous high, then is what we call a break of structure. Also this one. This is the place where the high was broken, a break of structure. Also this one, a break of structure, like that. Just to name them so that you can see them. A break of structure, a break of structure, and a break of structure. Again, like that. So that's a break of structure. In the case of what? In the case of an uptrend. In the case of an uptrend like that. That is what you call a break of structure. What of a break of structure in the case of a downtrend is when a trend continues and breaks the previous low. Not that one, but rather this one. The previous low. And what I want you to be very keen. We are saying when it breaks the previous low, not the previous high. So this is not our break of structure, this one. This one is not our break of structure. In the case of a downtrend, this one is not our break of structure. Rather, our break of structure is when a trend continues and breaks the previous low. So we're having our low right here. So where the market breaks that previous low, that one is our break of structure. This juncture at which the previous low was broken, break of structure. And this one right here also a break of structure. Break of structure. In the case of what? In the case of a downtrend. Like that. Remember the downtrend? The direction is like that. A downtrend. So in the case of a downtrend, that's our break of structure. Let's look at the other definition. So basically, let's see, yes, this is basically what we've explained, a break of structure. In the case of an uptrend, where it breaks the previous high, but in the case of a downtrend, it's where it breaks the previous low, not the previous high. I've seen people confusing with the previous high, but rather the previous low in the case of a downtrend. Then let's look at this other thing called the market structure shift or the change of character. So now what I'm saying, you'll find some people will call this a market change of character, or there's so many other videos that will have it. But as long as you can understand that this, it doesn't matter. It doesn't matter whatever term you call it, as long as you can spot this in the market and know that it has broken this, the term is of less importance. But for the purpose of this class, we'll call that a break of structure to make a difference. So anyway, a market structure shift We can also call that a change of character. So what is it? It is a trend reversal. So a change of character indicates a shift from the prevailing market trend. That is, if from a downtrend to an uptrend or vice versa. So let's look at that right here. We are having a scenario. Let me look for that space. Okay, perfect. So we are having a scenario. Maybe we are having our uptrend like that. Series, remember, series of higher highs and higher lows like that. Let's have that in green because it's an uptrend like that. Let me just do that. Yes, I want it in green like that. So it's an uptrend like that. So in this case of an uptrend, we are having our break of structures from this zone. Let me just name again so that you can repeat multiple times for people to remember. So a break of structure, then you're having another break of structure right here. Then you're having another break of structure right here. Then this market does what? Let me just name this one break of structure. What did I do? Okay, let me delete that. A break of structure at this point. Break of structure like that. So what the market does, maybe we have a scenario where now the sellers are in control and this market changes its trend and now it becomes a downtrend like that. Someone to tell us where our break of structure will be? Someone? From the higher lows or from the lower highs or from the lower lows? Where do we name our break of structure in the case of a downtrend? From the lower lows or from the lower highs? Joseph?
From the lower lows.
Yes, from the lower lows. So this point right here, this is what we call now a break of structure, and this one right here, a break of structure. So what is a change of character? We have been told that a change of character is a trend reversal. A change of character indicates a shift, or a market structure shift indicates a shift from the prevailing market trend. In this case, our prevailing market trend was an uptrend and it has changed now to what? A downtrend like that. A downtrend like that. So what do we call this? Now the zone at which we have that change is what we call a market structure shift. This zone right here, a market structure shift or a change of character. Change of character or a market structure shift. So you can actually name this a change of character, or you can just call it a market structure shift like that. So that's the case of what? An uptrend to a downtrend. The same thing for a downtrend to an uptrend, you can actually just use this. A downtrend to an uptrend, the same thing will happen. The market comes, change, buyers are now in control, does something like that. Series of higher highs and higher lows. It's an uptrend like that. Let me just have this. I keep on repeating these things so that they can understand. So like that. So we are having our break of structure. Do not get tired for repeating so that you can understand our break of structure is at that zone. Then our another break of structure is at that zone. But where is our market structure shift? The zone at which this market changed from a downtrend to an uptrend. This one right here. This one right here. That is now our change of character, or a market, or what? Or a market, where is my slash? A market structure shift. Like that. Change of character or a market structure shift like that. Let's see if we can identify. We can actually use what we had used right here. So if you come to this part, let me zoom out. This is a live representation on the chart. You can see we're having our uptrend. Then it changed from being an uptrend, and now we had a series of a downtrend like that. That zone, that one, a series of lower highs and lower lows. Let me have that in red. Like that. So we are having our uptrend at this point and a downtrend at this point. Our downtrend right here. So is our change of character right here, where it changes that trend, our change of character, or what we call a market structure shift. If you've gotten that concept, thumbs up. A market structure shift. You can identify a lot of them in the charts. You can always see them. This part right here, we had a downtrend, then we had an uptrend right here, series of higher highs and higher lows, an uptrend right here, very short-lived uptrend, but it's still an uptrend. So the zone at which this was broken is now what we call a market structure shift or a change of character, like that. Like that right there. So let's see if there's something you've missed on. So yeah, this is basically what I was explaining: an uptrend, market structure shift, a downtrend. In the case of a downtrend to an uptrend, a downtrend, then we had an uptrend. So basically that is what I wanted us to cover in this class. Slowly by slowly, we are building more concepts. Any question? Sly?
Yeah, so now what is the importance of that talk now in terms of trading?
Will get, no, what I'm saying, you are building slowly by slowly, you are building these concepts, you will get it.
Okay.
A change of character will come very in handy when you're talking about Quasimodo patterns. So no, what I'm saying, you are building these concepts pole pole too. So for now, just know that's a change of character, and make sure you can identify a change of character in the market. You can identify a downtrend, an uptrend, a break of structure, and all those. If you can identify those, that's all is needed from this class.
Okay, thank you.
Okay, any other question? If everything was quite clear, thumbs up. Perfect. Then I'll end this class from this juncture. We meet tomorrow for, what are you doing tomorrow? Order blocks and breaker blocks. And I want us to be having classes on Friday so that we can finish this course by, I think, day 23 of this month. So otherwise, guys, have a good night and God bless you. Bye-bye.
Thank you. Good night.
Bye, thank you.